Most people are misreading XRP right now. While investors are focused on daily price swings, a much bigger shift is unfolding in Washington that could influence how institutions elevate blockchain infrastructure for years to come. The market is reacting to headlines, but institutions are watching the regulatory framework being built underneath them. In this video, we'll examine why the Clarity Act matters beyond crypto, how monetary policy and regulation are converging, why liquidity, not speculation, is driving institutional discussions around XRP, and what history tells us about moments like this, ladies and gentlemen. See, the market has spent the past several weeks reacting to inflation data, Federal Reserve expectations, and political headlines. Those events matter, but they don't fully explain why digital asset regulation has become one of the most closely watched developments in finance. The Clarity Act isn't simply another crypto bill, ladies and gentlemen. It's an attempt to define the legal framework that institutions have been waiting for before committing more resources to blockchain-based infrastructure. That distinction is critical because banks, asset managers, and public companies don't allocate capital based solely on technology. They allocate capital within clearly understood regulatory environments. History shows us that major financial transitions rarely happen because of one announcement. They occur when several structural forces begin moving in the same direction. Today, improving liquidity conditions, advancing regulation, institutional interest in tokenization, and the modernization of payment infrastructure are beginning to intersect. That's why the conversation around XRP has become larger than price alone. It's increasingly about settlement, efficiency, market structure, liquidity, and the role digital assets could play within a regulated financial system. See, understanding that broader shift provides the context for everything that follows. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. See, one of the biggest misconceptions in cryptocurrency is that regulation slows innovation. In reality, many institutional investors argue the opposite. Large financial institutions cannot simply deploy billions of dollars into technologies operating within uncertain legal frameworks. Banks answer to regulators. Asset managers answer to compliance departments. Public companies answer to shareholders. Without clear rules, participation remains limited, regardless of technology and technological potential. That is why the Clarity Act has attracted attention far beyond the crypto industry. The legislation seeks to establish clearer definitions surrounding digital assets, determine regulatory responsibilities, and provide businesses with a more predictable framework for operating within the United States. Rather than asking whether digital assets should exist, the discussion has increasingly shifted towards determining how they should be regulated. Now, this is what most people miss, unfortunately. The conversation in Washington has evolved. Instead of debating whether blockchain technology belongs in the financial system, much of the debate now centers on details. How should stablecoins operate? What disclosures should companies provide? Which regulator should oversee different categories of digital assets? How should consumer protections be implemented? Those are very different conversations than the ones taking place a few years ago. And that evolution matters. Political negotiations naturally generate headlines, ladies and gentlemen. Different lawmakers propose amendments. Industry groups submit recommendations. Banking associations advocate for safeguards. Consumer advocates request stronger protections. See, from the outside, this can appear chaotic, but legislative negotiations often work exactly this way. Various stakeholders attempt to improve legislation before final passage. According to discussions surrounding the Clarity Act, many of the current negotiations focus on amendments rather than the outright opposition. Issues such as stablecoin yield provisions, ethics language, and additional regulatory safeguards remain areas of discussion. That distinction is important. Debating amendments is fundamentally different from reacting and rejecting the broader objective. Short-term noise, long-term structure, ladies and gentlemen. Investors often confuse the two. Markets may react emotionally to daily political headlines and the kabuki theater. Institutions typically focus on where the politics and the policy is ultimately heading, rather than every temporary negotiation along the way. History offers an important perspective. During the American Civil War, the United States faced an extremely fragmented banking system. Thousands of different banknotes circulated simultaneously. Many traded at discounts depending on which bank issued them. Trust varied from region to region. Interstate commerce became increasingly complicated because businesses could not always determine the true value of the money they received. The National Banking Acts of 1863 and 1864 fundamentally changed that landscape. They introduced nationally chartered banks and standardized national banknotes, creating greater consistency across the financial system. The transition wasn't perfect. It wasn't immediate, but establishing common rules dramatically strengthened financial infrastructure over time. Today's digital asset industry faces a different challenge, but the underlying principle is the same and similar. Markets function more efficiently when participants understand the rules. Legal clarity reduces uncertainty. Reduced uncertainty encourages participation. Participation supports liquidity. Liquidity supports adoption. History rarely repeats exactly, but it often rhymes. Another important element influencing today's political environment is monetary policy. Inflation trends continue shaping expectations surrounding Federal Reserve decisions. Inflation continues moderating. Policymakers could eventually have greater flexibility regarding interest rates. No outcome is guaranteed. Federal Reserve officials remain highly data dependent. Employment data, inflation reports, wage growth, consumer spending, and financial stability all influence future decisions. But markets continuously attempt to price future policy changes before they happen. Lower expected rates generally improve financial conditions. That can increase investment across equities, technology companies, venture capital, and digital assets. Yet easier monetary policy alone cannot build institutional adoption. Imagine lowering interest rates while maintaining regulatory uncertainty. Capital becomes available, but institutions still hesitate. Now imagine combining improved liquidity with regulatory clarity. That combination becomes significantly more powerful. This is why many analysts view monetary policy and regulatory policy as complementary forces rather than competing ones. One of the most significant developments discussed recently concerns the Federal Reserve's approach towards digital asset risk. Officials have emphasized an important distinction. Managing systematic risk does not necessarily mean providing bailouts. The message is relatively straightforward. Financial stability remains important. However, crypto firms should not expect government rescue packages similar to those witnessed during previous financial crises. Instead, resilience should come from strong management, transparency, adequate reserves where appropriate, and responsible operational practices. That philosophy encourages market discipline. Companies must build systems capable of surviving market stress rather than relying upon extraordinary government intervention. This approach could ultimately strengthen the industry's long-term credibility. Now, this is what most people miss. Institutional investors generally prefer predictable rules. They don't necessarily require favorable rules. They require consistent rules. Predictability allows risk models to function. Compliance departments can develop procedures. Legal teams understand responsibilities. Capital allocation becomes significantly easier. That predictability may prove more valuable than any individual regulatory provisions. Think about the construction of the interstate highway system. The government did not build highways because millions of cars were already using roads that didn't exist. The highways came first. Then businesses expanded. Distribution networks improved. Suburbs grew. Logistic companies flourished. Entire industries developed because reliable infrastructure had been established. Digital assets regulation could function similarly. Clear, legal infrastructure does not guarantee adoption. But without infrastructure, adoption becomes much more difficult. The Clarity Act, if enacted, could represent part of the foundational framework, providing rules that enable companies, developers, financial institutions, and investors to build with greater confidence. Prices react, systems evolving, and sometimes the evolution of the system matters far more than today's market price. This brings us to XRP, the anointed one, ladies and gentlemen. See, for years, discussions surrounding XRP have focused on a specific institutional use case. Rather than positioning itself primarily as a speculative asset, XRP has often been associated with cross-border settlement, liquidity provisions, and faster value transfer between financial institutions. See, whether adoption ultimately reaches its fullest potential remains uncertain. But the design objectives have remained remarkably consistent. As regulation becomes clearer, institutions may become more willing to evaluate blockchain-based settlement technologies. However, one critical question remains. Can blockchain networks efficiently support extremely large institutional transactions without introducing excessive friction? Because when banks begin moving hundreds of millions or even billions of dollars, the conversation shifts away from retail investing and toward liquidity, settlement, efficiency, infrastructure, and scalability. And that is where the next chapter of the story becomes even more important, ladies and gentlemen. This is where the discussion moves beyond regulation into market structure. One of the biggest misunderstandings surrounding XRP is that the institutional adoption is simply about banks deciding to use a different payment network. In reality, institutions care far more about liquidity than they do about headlines. Every major financial institution asks the same question before adopting any settlement technology. Can it execute very large transactions quickly, efficiently, and without disrupting the market? So important. Imagine a financial institution attempting to settle a $5 billion international payment. If the underlying asset lacks sufficient liquidity, executing that transaction could create significant price slippage and market instability. Large orders would move the market against the institution, increasing costs and reducing efficiency. This is why supporters of XRP often argue that liquidity and market depth are just as important as transaction speed. The XRP ledger was designed to facilitate fast settlement, but institutional adoption depends on more than speed alone, ladies and gentlemen. Deep liquidity pools, active market makers, and broad participation all contribute to creating an environment where very large transfers can occur with minimal friction. But here's where it gets interesting and spicy. Many investors focus almost exclusively on price. Institutions focus on market efficiency. Those are two very different conversations. For institutional participants, the objective is not speculation. It is reducing costs and settlement costs, improving capital efficiency, and minimizing operational risk. If blockchain technology can achieve those goals while remaining compliant with regulatory requirements, it becomes an attractive piece of financial infrastructure rather than simply another investment asset. Let this sink in. This is so massive, ladies and gentlemen. It is. See, the digital economy is also entering another transformation. Artificial intelligence is rapidly moving beyond chatbots and productivity tools. Increasingly, AI agents are expected to negotiate contracts, purchase services, allocate computing resources, and execute transactions autonomously. That creates an entirely new requirement. Meanwhile, machines will need payment systems capable of operating continuously, globally, and almost instantaneously. Traditional payment infrastructure was designed for people. The next generation of payment infrastructure may increasingly be designed for software. Everyone's missing this, unfortunately, ladies and gentlemen. Ripple's collaboration with the X42 Foundation reflects this broader trend. By combining XRP with stablecoins such as RLUSD, developers are exploring how AI systems can exchange value securely and efficiently while taking advantage of blockchain settlement. Whether these initiatives become mainstream remains to be seen. However, the direction of innovation is becoming increasingly clear. Artificial intelligence and digital payments are beginning to converge. Instead of simply asking whether blockchain will replace existing payment systems, investors are beginning to ask a different question. How will autonomous software transact with other autonomous softwares? This is going to be probably, in my opinion, one of the biggest subjects and themes to pay attention to. This may prove to be one of the defining technological questions of the coming decade. Because another important misconception is that traditional banks and blockchain companies must exist in direct competition. The reality appears considerably more nuanced. See, banks continue to play a central role in global finance. They provide credit, they manage deposits, they facilitate lending, they support businesses and consumers across every major economy. What blockchain technology potentially changes is not necessarily the existence of banks, but the infrastructure they use. Throughout the Clarity Act discussions, banking organizations have expressed support for regulatory certainty while also advocating safeguards regarding stablecoins, liquidity management, and consumer protections. This reflects a familiar pattern seen throughout financial history. Established institutions rarely oppose innovation outright. Instead, they seek frameworks that allow innovation while protecting financial stability. That balancing act is likely to continue as policymakers refine digital asset legislation. See, the objective is not choosing between traditional finance and decentralized finance. Increasingly, the conversation revolves around how both systems can coexist. History provides another useful lesson, ladies and gentlemen. Before standardized shipping containers were introduced during the 20th century, global trade was slow, expensive, and inefficient. Cargo had to be unloaded and loaded manually. Increasingly, costs, delays, and damage were out of control. The introduction of standardized containers fundamentally transformed international commerce. Ships became faster, ports became more efficient, global supply chains expanded dramatically. Importantly, the container itself did not create global trade. It made existing trade significantly more efficient. See, blockchain infrastructure may ultimately play a similar role. Digital assets do not create economic activity on their own. They have the potential to improve how existing value moves through the financial system by reducing friction, shortening settlement times, and increasing transparency. Whether that potential is fully realized will depend on regulation, technology, market demand, and institutional participation. See, consider the expansion of the railroad network during the Industrial Revolution. The tracks themselves generated little value. The true value came from everything that eventually traveled across them: factories, agricultural products, raw materials, people. Entire economies expanded because reliable transportation infrastructure existed. Digital payment networks may follow a comparable path. The blockchain is not necessarily the destination. It is the infrastructure. Applications, financial services, tokenized assets, stablecoins, and institutional settlement may eventually become the cargo traveling across those digital rails. See, if clearer regulation accelerates that development, legislation like the Clarity Act could represent one of the foundational pieces of that infrastructure. Markets naturally focus on short-term price movements. Every inflation report, every Federal Reserve meeting, every political headline, every earnings release, those events matter, but they should also be viewed within a broader structural context. The conversation surrounding the Clarity Act demonstrates that policymakers, financial institutions, technology companies, and regulators are increasingly preparing for a future in which digital assets become a permanent component of the financial landscape. Exactly how that future develops remains uncertain. Some blockchain projects will succeed, others may fail. Regulatory frameworks will continue evolving. Technology will continue improving. Competition will remain intense. Yet the broader trend appears difficult to ignore. Financial infrastructure is modernizing. Artificial intelligence is reshaping commerce. Tokenization continues attracting institutional attention. Cross-border payments remain an area where efficiency gains could generate substantial economic value. Price may fluctuate dramatically during the journey, but the underlying system continues evolving. Short-term noise, long-term structure. That distinction may become increasingly important for investors attempting to separate temporary volatility from structural transformation. The coming months, ladies and gentlemen, could prove significant for both digital assets and the broader financial system. If the Clarity Act advances, it could provide the legal certainty many institutions have been waiting for before expanding blockchain initiatives in the United States. At the same time, the monetary policy, inflation trends, and global economic conditions will continue shaping market sentiment and capital flows. For XRP, the conversation extends well beyond daily price action. Supporters continue to view its long-term value proposition through the lens of liquidity, institutional settlement, interoperability, and integration with emerging technologies, such as artificial intelligence. Whether that vision is ultimately realized will depend on execution, adoption, regulation, and continued technological development. No single piece of legislation guarantees success. No single technology solves every problem. But history consistently shows that periods of regulatory clarity, infrastructure, investment, and technological innovation often lay the foundation for the next generation of economic growth. And that is precisely why investors, policymakers, financial institutions, and technology leaders are watching this moment so closely. Because while today's headlines focus on politics and market volatility, the larger story may be the construction of an entirely new financial architecture. If you've enjoyed this analysis, be sure to subscribe to the channel, leave a like, let us know your thoughts in the comments below. Do you believe the Clarity Act could accelerate institutional adoption of digital assets, or do you think the market is still years away from that transition? We'd love to hear your perspective. Until next time, thank you for watching, and I'll see you in the next video. Well, I hope everyone's having a blessed Saturday afternoon. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Only videos coming next week on a lot more video topics. We're going to be discussing a lot of the cryptos that we discuss here right now, very, very much, and love very much. I want to discuss one thing that's very, very important right now. This is something that everyone must really take in, that Gucci conviction, that Gucci clarity. Why I'm saying this is because Clarity Act, bueno, no bueno, up, down, left, right, all over. The most important thing to pay attention to right now is the broader picture, not one piece of legislation. I remember when we first got into platinum and palladium over in Indonesia, the price of platinum was less than gold. That had only happened at certain times, but that didn't shake out our conviction, our Gucci clarity for what we were doing and why we were doing it. You don't allow the narrative of why you're in an asset to totally destroy what your thoughts of why you're in that. You don't do that. If you do that, you will get caught up like sushi. And if you're watching here on this channel as financial mercenaries that we preach, we don't get caught up like sushi because our convictions are pure and that Gucci clarity is pure when we get into this. That's the most important thing. Prices are going to go up, prices are going to go down. But the trajectory of the future is moving towards this. Japan has made a move with legislation on digital assets. You can't stand in the way of this freight train that's coming. I mean, if you want to, you'll get run over, and I don't want to see that happen. None of this is financial advice, just my own opinion and retention of capacity. You have to understand something. The macro of everything has changed. I was going over in the last Zoom call, and I'll see everyone tomorrow on the Zoom call as well in the Crypto Public Desk Monthly. The United States is $40 trillion in debt. 40 trillion. Where do you think this ends? I'd love to hear in your comments of where you think this ends. You're going to see erratic price moves. Again, the east and west side of the tranches. I would go over this perpetually. I haven't said it in a long time. Change is coming. You see changes in the Chinese gold market. You're seeing changes and adjustments everywhere. This is where you have to hold the line in your mind and understand your mind is a battlefield. You must be its general. You must control your thoughts. You have to. There's a million distractions. The Harry Houdini Freak Show continues to go. You must get excited for your future. You must understand the future is coming. I read all the comments here, and sometimes I don't get to answer all of them, so I try to answer them here. Look, come to the channel and vent here. Freak out in the comments about blah, blah, blah this, blah, blah, blah that. Let's have an open discussion about it. I love hearing on the Zoom calls everyone's concerns. Change is coming. At some point, these assets right now that are at rock bottom prices will not be at rock bottom prices any longer. The era of accumulation will be over, and you go back to straight trading. Right now, we have an opportunity to invest in rock bottom, cutting edge technologies that are going to change the world and happening right now. When the Clarity Act passes, and we are believe that it does, it's going to have a tremendous impact on certain cryptos, the ones we talk about all the time, ICP, HBAR, XRP, a lot of them, Link. You have to understand, this is the future of the world. I love trading commodities. I love being a financial mercenary. As to Remora, why I say this is we swim underneath the apex predators. We do what they do. It's not rocket science. You're not trying to beat the market. You're trying more to come along with the market. That's why my entire life, I've seen this story play over and over and over again. And then I heard the stories from the men and women that taught me everything I know, and then on a much higher level. So you have to ask yourself this question. As you work very hard for your capital, are you making your capital work harder for you? Look, ladies and gentlemen, if you want to learn to trade and you're still here at this point in the videos, Come and join the Crypto Public Desk Monthly. Come to learn to trade. Come to learn to invest. Come and join almost 620 active traders and investors who are learning to trade everything and interpret the financial chaos. One solid tip from the pits pays for your entire year subscription, ladies and gentlemen. But more importantly, when this era is over, when the era of accumulation is over right here, right now, this window shuts, it goes back to just trading the chaos, trading the wakes of the market. That's what happens. As long as King Daddy O Dollar keeps moving higher, rates will look to move higher. I don't think any interest rate hikes are coming, ladies and gentlemen. I told you this, and everyone long-term members of the Wolfpack, I said this when we thought Walsh was going to be nominated before anyone really realized what was happening. If you go back and look in the videos, we were always talking about this. If you're here now watching these videos, you're so far ahead of everyone else because as financial mercenaries, we just care about one thing, being correct. This is not a showboat. It's not about clicks, views. It's about being correct. So our bank account grows. Our trading account grows. Our benefactors grow. Our constituents grow. It's the name of this game. You have to ask something. Ask yourself this. Why are you here? I love reading the comments, but understand this. When the illusion of this changes, print it to when it's going to begin. It's not dependent on an election, ladies and gentlemen. It's financial, economic survival. If you get lost in the headlines, you're going to get cut up like sushi. Don't do that. Don't FOMO things. Follow your own recce. Follow your own plan. I'm trying to have a more heart-to-heart talk here right now because at the end of the day, I think people are totally negged out. See, I don't care about odds this, odds that, blah, 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 blah. This person said this, blah, 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 blah. This odds market said this, blah, 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 blah. I don't care. This is about winning. That's it. If you don't know why you started, you don't know why you'll finish. I love being a financial mercenary. I was born for this. I was designed for this. I talk about things in the part of this video, like we go over sulfuric acid, because we get phone calls every day at our refineries in Indonesia, people sourcing things. When I explain things at this part of the video, it probably goes over most people's heads. The demographics of our channel mostly are 40 plus. So we're not a young channel viewership. Most people who have gotten to where, at least where I'm at in my life, did it through hard work, determination, sleepless nights, and the commitment to excellence in the financial markets above everything else. That's why I don't watch TV. I don't have time for it. I watch news channels. I read newspapers. I need to know everything that's happening around the world before people know it. My livelihood and my benefactors' survival completely, justifiably maintain and matter to that. No one. Information is free. Right now, I have set the table through multiple videos of what we're watching, why we're watching. You got the chaos. You got interest rate higher, lower. That theme changes every day. See, if you don't understand what's going to play out down the road, how can you navigate right now? That's like driving a boat into shallow water. You're going to just beat yourself and get crushed and sink. Understand this right now. Anybody can make a transaction in any financial market. A true disciplined financial mercenary has the conviction to understand why they did it in the first place. Because if you don't know why you did it in the first place, why did you buy an asset? Why would you do that? I'm not going to put price points right here when I think about the metals markets. The easier plays are what I talk about. That is like watching paint dry on the wall. It really is like watching paint dry on the wall. The most successful plays are the plays no one pays attention to because they're boring. I tell everyone in these videos to pay attention to what's quiet. That served me well. I enjoy giving back on these videos. I like my little rant parts of these videos. I love talking to everyone in the Crypto Public Desk Monthly every Sunday. I love more giving back because, unfortunately, I think it's better to be in position than not. That's why we don't believe in leverage. I think a heartfelt play is a plan that you're doing and why. That's it, ladies and gentlemen. But until the freak show of news ends, people are going to get caught up like sushi. The banks and CTAs are playing to make their weekly, monthly, and quarterly numbers. They got to make sure that their disclosure sheets and their one pages are met. Their game is about hitting their numbers. It's not about strategic positioning. It's about hitting numbers. We have to do the same, but we believe in strategic planning. See, when you've gotten to a certain point of wealth, you need to preserve your wealth. You don't want to have to make your money over again. And I understand this better than most. Without a plan in this market, you're dead in the water. Your financial goals will look like a mirage. None of this is financial advice, just my opinion or intents at a capacity. This video is for educational purposes only. It's not financial advice. Always consult your own licensed financial advisor. Never, ever invest any capital, any money based on watching a YouTube video. That's just totally insane. Commit to the process of excellence. That's having a plan that personally makes sense for you and your family. Most people watching these videos have a second job just to invest. That's spectacular. That's very smart. Don't overextend yourself. Don't get cut up like sushi. I love you all. I'll see you on the front line, ladies and gentlemen. Have a blessed Saturday. I'll see everybody Sunday in the Zoom call.